Hey guys, I'm here answering more of your questions. The question that we're going to look at today is all about economic indicators. So for example, ISM, PMIs, GDP, NFP, all those indicators that are released on the calendar every week in a cycle, we're going to be looking at those. Now the question is, well, lots of people are wondering, how do you know which ones are important, why are they important, and how can you kind of know what's going to happen with those indicators? Okay, so for example, if you've got an upcoming GDP report, how do you know whether to buy or sell that currency around that report? It's a good question, and there is an answer to it, so we're going to look at that now. So the short answer to the first part is that it all depends on the central bank. So for example, if the central bank are concerned about the economy, they're concerned about growth, and they're thinking that they're going to cut rates because growth is too low and they need to try and spur it, then the big focus of the market will be on growth-related economic indicators. So for example, GDP will all of a sudden become a very important one, but all the growth indicators will be important too, because traders will use that to ascertain, okay, the economy is either growing or not. If it's not, that's going to make the central bank act and of course cut rates, which of course means sell the currency. On the other hand, let's say for example, the Federal Reserve from the US are thinking about hiking rates, but they want to see sustained improvement in the labour market. So again, forget GDP now, the market for the US is going to be focused on NFP, jobs data, unemployment, average earnings. Those data points now are going to be the most important that everyone's focusing on. So basically the data points go in cycles of importance, okay? So it's not just like PMI is always important. Sometimes PMI will be the most important indicator of the month. Other times no one will care, and it's all about what the central bank are looking at, what they're concerned with, and what their next action might or might not be, depending on what that data is. So the first thing you need to do is keep your eye on the central banks, keep your eye on the analysts to see what everyone's saying in terms of what the most important data points and economic indicators are. That's the first thing. Now, when you've got one, the next thing is how do you trade it? Well, one thing I love to do is trade something called buy the rumour, sell the fact. So for example, let's say the UK are going to hike rates. Everyone expects them to hike rates at some point. Now let's say that the last couple of weeks the Bank of England have been really hawkish. Their comments have been supporting that view. Yeah, they're going to hike, it's all going on. We're still really positive on the UK economy. And then we've got a big data point coming up the following week. So let's say, for example, GDP. Now let's say GDP is expected to come out stronger than it was previously. When it lines up with the underlying fundamentals, the view of the central bank, what everyone's thinking already about the UK economy, when we've got this big data point, and by big I say there's three big data points. You've got employment, you've got growth, you've got inflation. They're the big three data points that are always going to be important to the economy. So when you've got one of those big data points coming up, you've got the background lining up, matching it, you know, so it's all positive, and we expect that number to be good, then of course we expect the pound in this example to rally into that data because it's positive on before and it's expected to be positive at the end. So in the between, there's no reason for traders to sell the pound, only reason to buy. That's the kind of way you can look to use these indicators to trade and find tradable opportunities. Now, not every indicator is going to be like that. Sometimes you'll get a random indicator that there won't be anything kind of surrounding it, so it's not really tradable. Other times, you'll get an indicator that's expected to come out with one figure, but it comes out at a big deviation, a big shock, completely different to what was expected. This is another example of how you can trade those indicators, but this time, instead of trading into it, you can trade out of it. So you wait for the deviation, it comes out, you react and trade out of it. So there's lots of different ways to make money from trading indicators. They can be predicted, not every time, but there are certain scenarios where you can predict exactly how the market's going to move going into one of these events. But the key is to understand the overall underlying fundamentals and the sentiment running up into that indicator. It must match with what the market's expecting. So if they're expecting a positive figure, the whole sentiment and fundamentals have to be positive, vice versa. If it's negative, everything has to be negative leading up to it. So, hope that helps. Please keep your questions and comments coming on the blogs and the socials. You know, it gives me the fuel to answer, you know, make these videos and answer your questions. And hopefully this information has helped. And I'll be back soon with another video answering even more of those questions.